G'day expats and welcome to another episode of Expat Chat, episode 189 today. And yes, Brett and Adam are back. G'day Adam.
Hey Brett, how's it going?
Mate, all well, all well. I was just briefing on the update of the office reno, so good to see some activity starting to happen. Like I alluded to in the last
Finally.
episode, finally I think we've got every signature from every person in UAE. It's all 10 million of them, so no one left to sign. So if anyone else wants to sign a document, let me know because everyone else has signed it. So, mate, we're getting there, and today we're going to do the part two for the podcast. Obviously, all the information we're going to share with the good folks on the call today should be treated as informational or educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, please speak to a licensed and experienced specialist. Mate, UK, let's talk about it. So obviously where we left off last time, we're talking about UK pensions and those sort of things. And we kept the episode quite brief because there's a lot more to go through. Today, let's talk about tax deductibility of ISAs after you've left the country. Let's talk about UK inheritance laws. And I think we'll wrap it up with retiring to the UK, which we're seeing more and more of these days, and how a super account in Australia in pension phase, how that's treated by HMRC. So, mate, let's get the cab off the rank. Obviously, ISA accounts you alluded to in the last call. Yeah, certainly appealing locally when you're a UK resident. How is that treated differently once you jump on the plane at Heathrow and either move to somewhere else or back to Australia?
Yeah, so as we touched upon last time, ISAs are tax-free entities in the UK. Any dividends you receive within that structure is tax-free. Any sales and if you generate capital gains, it will also be tax-free within that structure. However, that is for the UK only. Once you move overseas, say back to Australia, Australia will treat it like any other investment account, which will mean deemed acquisition on the date you return, and then suddenly it's in the Australian tax net from that perspective. So yes, while it is great on the UK side of things, being able to put in £20,000 into a tax-free entity, normally, when people do move back to Australia, they sell something like that asset and then, bring the cash back to the Australian tax net because essentially it's going to be taxed in Australia anyway at that point.
No, exactly right. And then it's the thing, it's we always talk about either that further expatriation or that repatriation phase. You need to do that review at least 6 months out of your assets. I mean, we always joke about expats collecting assets like baseball cards. Definitely the case with clients in the UK, that's for sure. We do see a lot of ISA accounts. So certainly I think the big thing for a lot of folks out there is just it might be easy to leave there, might feel good and sound good, but obviously, especially if you are returning back to Australia, you are making your financial affairs more complicated. Obviously, with UK pensions, you don't have to report that to the ATO unless you start drawing on it, but certainly ISAs you do. So if you're doing a domestic tax return in Australia, guess what? Now you're reporting domestic and international assets. Accountants love that because more complex, they can charge more. And you're actually not getting any tax benefit by continuing to hold it. And that's a big thing we run into a lot. People go, oh, I'll deal with it later. We see the same thing with 401ks in the US with clients. They think, oh, I'll just redeem that at a later point when I get back to Australia, not realizing that taxable event. And yes, there is a DTA both between the UK and Australia as well as the United States and Australia. But guess what? The Australian marginal tax rates are higher, so you're going to pay more tax anyway.
Yeah, I would say that the only benefit of keeping an ISA would be if you were going to return at some point.
Spot on.
But yeah, if you do go back to Australia on the day you arrive back, assets are valued or bought from an Australian tax perspective as at that date. Say you stay in Australia for 5 years and then you want to return to the UK, then you're looking at deemed disposal as well on the Aussie side. There are ways to offset tax in Australia though. And then if you return to the UK, your ISA just, continues on. But I would say that's the only, I guess, caveat to selling.
Spot on, spot on. Well, mate, let's run on to the next cab off the list, and obviously talking about UK inheritance tax, and that's been a big topic of discussion. And I will caveat this comment to say it might change again. We do have politicians involved, so like we've seen with Canberra over the last couple of months, they love to do a good back flip and a front flip and a side flip over time. So long story short, it's going to be a wait and see approach, but for the time being, let's run through with the audience just how the UK inheritance rules work under the new regime.
Yeah, UK inheritance tax is quite severe, actually. So baseline rate is 40% on someone's estate. However, you do get a tax-free threshold of £325,000. So just transferring that to AUD roughly, it's about 615,000 Aussie dollars off current exchange rates, but that does move around a little bit. So yeah, £325,000 tax-free, and then anything above that, a flat rate of 40% applies. Now, there are some exemptions to this. So if you leave it to your spouse, legal spouse, it is tax-free. However, then we need to start thinking about that person passing away. Sorry, that sounds a bit grim. But
That's
that
reality.
person passing away, yeah. Yeah, unfortunately, we have to talk about that a lot, Brett,
Yep,
in our jobs. But
goes with the job.
yeah, then we need to think about their threshold as well, because you could essentially double that depending on, what each partner holds. If you do transfer it over to a child, so a legal child, grandchild, the tax-free allowance does jump up to 500,000. So just in Aussie dollars, you're looking at 945,000 off current exchange rate. So that is a little bit of a benefit for children, but look, with high income tax households, like we need to start looking at things like that. Now, I would say, okay, how do we get around things like this? Obviously, you have your charity donations, you don't pay inheritance tax on things like that. However, what we've seen people starting to do is gift in whilst they're still alive. So I have seen gifts being given, you can give £3,000 each tax year without it counting towards your estate. Or there is something called the 7-year rule where you can give larger gifts, which can be tax-free if that person making the gift stays alive for 7 years.
Yep. Yeah, and I've seen also case studies where if a husband passes a pension to a wife and then she then passes that on to a sibling, sometimes the sibling will get taxed for the whole amount. So it's something that if you are considering this, you do need to speak to an estate planning lawyer in the UK. We have a couple that we work with, and I think that's the most important part of that sort of framework is it's morbid, yes, it's real, yes, but it's a necessity. We always joke about, doing a will. It's that one document you put a lot of effort and time and money into to never want to use it. You want to put it up on the top shelf and then never touch it again. And I think that's the same thing with dealing with inheritance tax. Ireland's got a very similar regime to the UK, so they are quite punitive if handled incorrectly. And I think that's the big thing we need to just remind the audience that you do need to have these issues addressed. Mate, last cab off the rank. Obviously, we're talking about retiring to the UK. Now, we joked about on the last call, if you get too much sun and you want a bit of grey skies and rain, then it's a nice place to retire to. And saying that, they've had heat waves and all sorts of stuff. So the world's certainly changing on its ear. But let's run through if you were, let's say you're living in Australia for 40 years and you go, you know what, I've always wanted to travel through Europe and live the life over there in retirement. Due to hereditary reasons or whatever, I'm allowed to retire there and live there permanently, but I'm drawing on allocated pension from super. How does that affect their cash flow? Because we've obviously talked about this before, about things being backwards. France is the same as well too. Most countries are the same. Australia is the only country that taxes in accumulation. So if you were a retiree couple looking to retire to the UK, well, let's run through that scenario and how that looks.
Yeah, so UK, I'd probably call it a thrice tax regime,
Yep.
where one, they tax people whilst they work in the UK, basic income tax. When they retire, they also tax you in retirement, whether you're drawing a UK pension or a foreign pension like Australian superannuation. And then, as we just mentioned as well, inheritance tax after, which brings up the number three. So with drawing Australian superannuation and retiring to the UK, which I'm actually seeing quite a bit more now, is people not actually wanting to go back to Australia or returning to the UK for good. Australian superannuation, it's taxed in accumulation. That tax rate is between 10 to 15% as it grows. When you retire, you can move into a tax-free pension, conditions of release, age 60 and cease an employment arrangement, or age 65 otherwise. Once you start withdrawing that pension in Australia, it's tax-free on that side. However, the UK doesn't treat it as a tax-free pension. Normally, if you start drawing out regular pension payments, they're fully taxable in the UK, so they will go straight into a UK tax return at your marginal tax rate in the UK. So, that ranges between 20 and 45%. It is a big taxing nation like Australia. Lump sums can be treated a little bit differently. There are some foreign service relief rules. However, it's still going to be taxable in the UK up to a certain point. So UK tax rates, I did mention, are quite severe as well, like Australia. There is a better tax-free allowance though, so up to £12,570, that's the tax-free threshold. And then up to £50,270, that's the 20% rate. So if that is the situation you're in, you really want to control your tax rate on the UK side of things if you're drawing an Australian pension, because essentially you are getting double taxed as well. Your super has been taxed your whole life, and then suddenly the UK are getting their piece of the pie as well. There are some strategies, though, Brett, depending on your age, which would you like to go through?
Mate, you're on the roll. I'm sitting here with popcorn, enjoying the flow. So keep going.
Yeah, so look, a situation Brett and I see quite a bit is if someone is going to stay in the UK, we say do a farewell tour or a trip back to Australia, which is for an extended period of time, a time at which you become an Australian resident again. So subject to superannuation conditions of release that we just went through. If you become an Australian resident again, time the tax year is right, you can actually withdraw your superannuation tax-free as an Australian resident, put it into your bank account, and then, as we say, take a metaphorical briefcase full of cash back to the UK. So provided you're not a UK resident at that time of withdrawal, then, you're bringing it into the tax net anyway, but you do or can avoid the income tax on that withdrawal.
Yeah, because that's the big thing that catches a lot of folks out is they do the withdrawal down and it's treated as assessable income. Same as in the United States. If you draw down 100% of your super as a as a US tax resident, you'll pay 100% tax on that. So, that farewell tool becomes a pretty important part of your financial planning. 9 times out of 10, you want to catch up with family and friends anyway. Think about the savings and tax. People go, oh, but what about the cost? I guarantee the cost is far less than the actual amount of tax you'd pay if you decided to draw that out of the UK. So just work on a weighted approach when it comes to considering those things, because that's, to me, the big thing that people miss is in retirement, you're flexible. You've got the right of abode in Australia. If you get to retire in the UK, then you have a right of abode there. You're able to, I wouldn't say manipulate, but manage your affairs that suits you. And if it means go back to Australia and do a lap around the country, tick all those boxes, Uluru and all that sort of jazz, guess what? You've just saved yourself some money and had a great time. And then return to the UK with that metaphorical briefcase full of cash. And I think that's the thing that catches most folks out is they don't understand that by taking control, they can manage their situation to their benefit. We see this all the time, not just with UK clients, but all clients as well too. We've got a client who, they'll be moving back to Australia soon, and the end destination is Tasmania, but I've got them going via Perth because I want them to move back into their former principal place of residence in Perth, spruce it up, do it up, live there for 12 months, sell it, and then take those proceeds, capital gains tax-free, and that'll go into Hobart. And just that little thing, I said, do you mind Perth? They said, no, we love Perth. Right. We just saved you probably $400,000 or $500,000 in tax. So, that's why this planning phase, both into retirement and also changing countries, is such an important part, because you might have good intentions and it might feel good doing X, but in actual fact, you should do Y. Not always is the Excel spreadsheet correct. There's times that you and I do this all the time. We say to clients, we want you to do this. And they're like, but I don't want to do that. And that's fine. But at least you're doing it with informed information. And you can never say after the fact, if I'd known that, I wouldn't have done that. It's a very empowering thing when you're managing your financial affairs to be able to go in and say, hey guys, I've done everything right. Or I did everything I wanted to do, but with the full facts and information at hand. So certainly UK, the goalposts are moving quite regularly there when it comes to, tax and those things, like in Australia, like everywhere in the rest of the world. Politicians have this new plaything called legislation, but they can really bang around and sort of move things quite a fair bit. So the big thing for us, we always say to clients, is when you're fully informed, you can execute with intent. That's what it boils down to. What suits you with the information. You're never going to get a 100% result. And I think that's that analysis paralysis we see with clients all the time moving countries. They get into this situation where they're looking for that 100% answer, and it doesn't exist. I'm here, folks, to tell you right now, as good as Adam and I and the rest of the Atlas team are, no one ever gets a 100% result. But if you can get a good 80 or 90% result with a bit of compromise, that's the best answer. So
yeah.
Mate, I think
definitely. And look, I'll just say, like, if you do go down that strategy of withdrawing from super as an Aussie resident too, it's important what you do next as well. Super is actually one of the best retirement systems in the world, from a growth point of view as well. And that growth element is really what takes people through to date of passing, actually. So you don't want to be drawing out a percentage a lot higher than what it's growing. So if you do withdraw that super, you need to look at an alternative for retirement growth and income.
Mate, you touched on a good point there too. Yes, super is probably the envy of the world when it comes to pension schemes. I think the only caveat I'll say to that strategy I was mentioning before, or you were mentioning before about the drawdown, is if you do have an intention to return to Australia, let's say you want to do 10, 15 years in the UK, then to return to Australia, then you need to employ a different strategy again, because the last thing you want to do is return to Australia to find out you've got nothing in savings and tax-free. So the strategy we were talking about before about obviously doing 100% drawdown and taking the money to the UK, that applies for people who are retiring there permanently. Yeah. If you are going to do 10, 15 years in the UK and then 10, 15 years back in Oz, there's a different, and as you can see, we're going down so many rabbit holes and there's lots of different options, and that's what keeps us busy, sort of building those strategies for clients. But I think that's the overriding fact is everyone's different. Sometimes people want optionality. That's the other thing too. They might say, look, there's 70% chance we're going to stay in the UK forever, but ... Now, and that's the case, then you have another strategy as well too, because I think those are the things that we see all the time, that clients can make informed decisions with the information at hand at that present point in time. But things change. You might have moved to the UK to be with your brother and sister in retirement. They pass away, and then you go, there's no one here for me. I want to go back to Australia. We see that as well too. So always go through those moving parts and just sort of reassess and say, rightio, this is a key situation. We need to look at this and I think I said, find what works best for you while trying to optimize your tax situation at the same time. Don't let
Yeah,
the tax drive you. You should drive the tax.
yeah, exactly. And keep in mind as well, if you are jumping around countries too, from UK and Australia and backwards and forwards, that the UK inheritance tax tail still exists in
Yeah.
that time as well. So just to quickly go through that,
Yeah, that's a
uh,
good one. Let's go.
yeah, if you stay in the UK for a certain time period, so 10 years, you get a 3-year tail. You need to stay alive to get out of the inheritance tax net. So just putting it simply, between 10 and 13 years in the UK, you have a 3-year tail. You need to stay alive if you leave the UK. And then it progressively goes up. So 14 years in the UK, you have a 4-year tail, 15 years, 5 years tail, and it progressively goes up all the way to a 10-year tail.
So, folks, I think we'll leave it on that note right there. If you are going to leave the UK, just don't die straight away. It'd be very selfish of you. HMRC and the UK government will thank you for your donation. But at the end of the day, yeah, I think the big thing, the moral of the story is just be careful. There are a lot of landmines out there, tripwires out there. Always be mindful of what you're doing. Just sort of ask yourselves, is this the right option? Don't ask your neighbour, don't ask your brother and sister unless they're doing this job because they might have good intent, but they might not be fully informed or it might have worked for them 10, 20 years ago, but as we know, every month these laws change. So that's keeping us on our toes. If it keeps us on our toes and we do it full time for a job, then a lot of folks out there will be experiencing more difficulty anyway. So, mate, we'll wrap it up there. I think we've filled the guys and girls' minds with a lot of information that may or may not be pertinent. So for those folks who aren't in the UK and have nothing to do with the UK, then we appreciate your patience and hope you learned something along the way. For those folks in the UK, we hope this was especially useful for you guys because, it's an evolving piece and the world is getting smaller digitally and the governments are finding more and more ways to tax you. So our job is to just provide that guidance to expats around the world and keep everyone on the straight and narrow.
Yeah, most definitely, particularly dealing with two big taxing nations as well. So
Yeah,
yeah, very important not to make those types of mistakes.
exactly. So, mate, we'll leave the folks there. Thanks for your time once again, and we'll see everyone on the next episode of Expat Chat. Take care, mate.
Thank you, everyone. Have a good day.
Take care.